Hi, welcome to this video on financial markets. In this video, we will be discussing primary and secondary markets and a few basic issues related to them. So we all understand by now what financial markets are, and that they are not like everyday markets where we buy chicken, vegetables, bananas, and other perishable objects. These markets are here to allow companies to raise capital and to allow investors to trade. As the name says, capital market, related to capital. So when firms need to raise money on a short-term basis, they engage in what we call the money market, low maturity of up to 1 year. But when the firm's requirement for raising capital is for more longer term, we get into the capital market. The capital market is subdivided again into two segments, primary and secondary. The primary market is where companies issue new securities, such as shares, stocks, bonds, for the first time. Pay attention to this part, for the first time. They raise this money to finance their business on a long-term basis. So this is to meet their long-term capital requirements. Issuing new shares in the primary market can happen through several different routes. Initial public offering, issuing rights, or private placements. We will discuss about the IPO in a bit later in more details. The IPO is essentially a process where a company offers its shares for the first time to the general public. In the case of rights, the company is issuing new shares to existing stockholders in a proportion or a ratio consistent with their current holdings. So for example, a company announces that they will be offering right shares at a 1-to-1 ratio. That means that every existing shareholder will have the right to subscribe to another new share. So if you hold 1,000 shares, you will be entitled to receiving another 1,000 shares. So of course the number of shares increase, the amount of capital raised by the company increases, but the downside to that is the profitability of the company does not increase. So the EPS goes down, the earning per share goes down, because earning remains the same, but the number of shares goes up. As for private placement, in this process, the company sells its shares to a select number of privileged large investors such as mutual funds, pension funds, hedge funds, etc. So, as you can see, in a primary market, no trading takes place. No trading at all. But what good is owning shares if you're not able to sell them when you need money? What is the point of a market if you're not allowed to liquidate? The need for liquidity is extremely important. And to facilitate this, secondary markets came into being. Secondary markets are where shares issued in the primary market are bought and sold. So all the stock exchanges that you see or know of are examples of secondary markets. The secondary market is important for several reasons. One is to provide liquidity to shareholders and bondholders so that the existing stock or bondholders can sell their holdings to convert them into cash. Another is to allow new investors to join the market. That means people who were not fortunate enough or simply could not receive the shares of a company when it went through the IPO process through the primary market can now be owners of that company. And lastly, to support the primary market. That means if investors know that the shares that they receive in the primary market will have a resale value, they will be more interested to buy the shares of that company. Now, on the other hand, if they think that the secondary market trading of that company will not be good and will not be very liquid, they will not be so interested in engaging in that IPO. As a result, the company will find it difficult to issue new shares because the general public are simply not interested in buying it. And the difficulty of issuing shares leads to difficulty in raising capital. So, to summarize, here are some of the key differences between primary and secondary markets. In terms of issuance, in primary market, shares are newly issued, newly minted, and in secondary market, these are old pre-existing shares that simply change hands. In terms of trading volume, in the primary market there is no trading at all. But in the secondary market, the whole purpose is to facilitate trade. So trading is indeed very active in the secondary market. The primary market is also not nearly as busy as the secondary market because IPOs do not take place on a daily basis even in the most developed economies. By contrast, secondary markets are extremely busy. Trillions of dollars worth of securities and financial instruments keep changing hands constantly. As for sellers, the sellers in the primary market are usually the corporations, the companies, the firms who want to raise capital for their long-term financing needs. But in the secondary market, it's just investors like you and me who are the buyers and sellers. But on the other hand, for the primary market, the buyers are investors such as institutions, hedge funds, pension funds, and underwriters. So pretty much all sorts of investors. In terms of objective, the goal of a primary market is to facilitate long-term capital raising. But the secondary market's goal is to support the primary market by providing liquidity and information. And another thing you will notice is that the company is involved only in the primary market. When people subscribe to an IPO, the money that they pay directly goes into the company's account. But in the secondary market, when shares change hands, nothing goes to the company. The company is not involved. Only the buyer and the seller of the shares are the people who are impacted by that trade. So, now that we understand the key issues related to primary and secondary markets, let us move on to an important issue on primary markets: the IPO, or the initial public offering. Firstly, how does an IPO work? Now let us put ourselves in a company's shoes. Say we're a healthcare provider company with hospitals or medical surgical equipment manufacturing facilities, which have been operational for about a decade or so. And our company is generating a good amount of profits from business operations, and we want to expand into more promising areas. We need more money to achieve that, and therefore we want to tap into the IPO market to raise more capital to finance our expansions. To make this work, the first thing we're going to need is to hire one or more underwriters. Underwriters are licensed institutions, usually investment banks, who will conduct the IPO process on our behalf. These are usually large investment banks who will liaise between the company, the investors, and the regulatory agencies, usually the SEC, the Securities and Exchanges Commission. After that, the underwriter will work with our company to get the documents ready for registering the IPO process with the SEC. At this point, the underwriter will also help create a prospectus for distribution to the general public and potential investors. They will also do the due diligence to make sure that all the information is correctly and accurately and in a legally acceptable way represented. So, if all the things go smoothly so far, the underwriter will then be able to apply on our company's behalf to the stock exchange to get listed. At this stage, the underwriter will try to create a buzz around our company, kind of in a way that influencers influence. So they will try to promote our company through media, through extra coverage, and other means. The most common way of doing this is through a roadshow. They will travel to established financial hubs and centers such as New York, Chicago, London, Hong Kong, Singapore, any place where large investors congregate and big funds are stationed in. The idea is to attract them to invest in the company. Now, of course, in modern times, a lot of these things take place virtually, but in the older days, the underwriters used to tour around on the road, on the bus, travel from one city to another, which is how the name roadshow came about. So the roadshow is not literally roadshow, but the concept is they will travel and try to go to places to seek potentially interested investors to provide funding for the company. The next step is price discovery. That is, deciding on what price the company should sell their shares at. There are two popular ways of determining this price. One is a fixed price issue, and another is a book building issue. In the fixed price method, the amount is already predetermined and there's no need for bidding. But for book building, the investors are invited to submit closed envelope bids to engage in a bidding process within a certain price range. At the end of the bidding period, a certain formula is going to be used to calculate the final indicative price at which the stock will be issued. And that brings us to the last step, actually selling the shares. Once the shares are issued, investors will deposit their money, which will then be channeled through the underwriter into the company's bank account, and the investors will receive their shares. That concludes the IPO process, and the investors get their shares, but at this point, they will not be able to sell them. They can only sell them in the secondary market when the stock debuts in the stock exchange. Also, when we say underwriting, it does not necessarily mean that an investment bank is going to take all the responsibilities alone by themselves. There are different ways this can happen. In the event of a full underwriting, there's only one investment bank who takes on the responsibility and promises to buy all the shares in case that the public does not want to buy. So, the liability of the underwriter is to buy and pay for the entire unsubscribed portion of the IPO. So they take on a huge amount of risk here, especially if this is a big IPO with large amount of dollars involved. But sometimes there are partial underwritings too. So in a partial underwriting, the liability of the underwriter is to buy and pay for only a portion of the unsubscribed number of shares. In this case, the company that raises the capital and the investment banks negotiate the terms and conditions and pre-agree on the percentage of the guarantee. More commonly, in the event of very large IPOs, there's a syndicate that takes care of the process. So in a syndicate, several investment banks join hands together to guarantee purchase of the unsubscribed number of shares. In this way, the underwriters attempt to minimize their risk and exposure by not taking up too much unnecessary amount of liability on their shoulders. So, from the discussion so far, I'm sure you get an idea of how important underwriting is for the entire IPO process and by extension in the primary market. There are different types of underwriting available, and there are two main ways in which underwriters operate and deliver the shares to the general public. The first and more common way is through a commission-based service, and the other one is an outright purchase without commission. For a commission-based service, one investment bank or multiple investment banks jointly or in a team or a syndicate of investment banks guarantee a company that their shares will be sold to the public. And for facilitating this, for providing this service, they will charge a certain percentage of the IPO proceeds as their fees. So let's say a company is going to issue a $500 million IPO. That means that the company is looking to raise $500 million worth of capital for their long-term needs. So this is a big amount. A syndicate of investment banks, let's say comprising JP Morgan, Goldman Sachs, Barclays, and Deutsche Bank, get together and they decide that they will make this happen. They will sell the shares to the investors, and for this service, they will charge a 2% commission. So once the shares are sold, the company will receive the $500 million in cash, but minus the 2% commission. So 2% commission comes to $10 million, so the company will eventually receive $490 million. On the other hand, in the case of an outright purchase, there are no fees that are charged. The underwriter or the syndicate buys the entire amount of shares from the company. Why, you might ask? Well, the syndicate will give $500 million to the company and buy the shares themselves. Then, they will aggressively advertise those shares and the company's prospectus or prospects to the investors and try to sell them at a price as high as possible. And whatever the difference is, that is their profit. If this is unclear to you, let's try an example. Let's say a syndicate enters into the no commission mode of IPO. So they give the company $500 million and they receive the shares equivalent to that amount. So now they have $500 million worth of shares in their hands, but they don't have $500 million in cash. Now the only way they can make money is by selling those shares to the general public at a price as high as possible. So let's say the investment banks got to work and engaged in an aggressive campaign of selling those shares to different pension funds and hedge funds. And after selling all those shares, they calculate that they received $620 million in total. But they already paid $500 million to the company, so the extra $120 million will be their profit. So in this method of underwriting, the investment banks carry a higher degree of risk and usually look for maximizing their returns as well. And they do this when they have confidence on their selling ability and also their reputation. Because the underwriters perform this significant task of channeling money to the businesses who need them in the capital market, they play a vital role in an economy. They're undertaking a guarantee to buy and pay for the shares placed before the public in the event that there's a non-subscription. Non-subscription means that the shares are issued, but they're not sold. They're not sold to the public. So now the original firm is stuck, issuing shares but no cash. Thus, in an underwriting process, the issuing company is ensuring or assuring the firm that the necessary amount of funds will be available to them, so that they can go on and concentrate on their core business activities and worry less about where and how the funds will arrive. Another thing to remember is that underwriting of capital issues by highly reputable institutions can also help firms in getting an extra mileage on their reputation and goodwill and brand value. The reputation of the investment bank involved can also help increase and improve the responses of the general investors. In fact, investors in the more developed countries are influenced by the prestige of the underwriting agencies rather than the prestige of the company going into the IPO. For example, for the now infamous example of the 1MDB venture, who was the investment bank that partnered up with them? It was Goldman Sachs. So the idea for 1MDB was to leverage the reputation and the selling ability and the network connection of Goldman Sachs to raise the billions of dollars worth of funds. So the investors, when they see that, well, Goldman Sachs is involved, so this must be of very good quality. And that's how new funds were raised. So you can see that the reputation of the investment bank in the underwriting process plays a very big part. Also, let us not forget that the underwriters actively write and manage the prospectus. They know the company well inside out. They also help the companies abide by the laws and regulations within that jurisdiction, so they can transmit valuable information to all stakeholders, from the regulatory bodies to the ordinary investors to the overseeing authorities such as the central banks and exchange officials, etc. In addition to that, underwriters provide essential information about the issuing companies to the prospective investors, the people who will be paying the money and buying or selling those shares in the secondary market, and also advise them on various issues. So by encouraging and guiding the IPO process towards a fair price, they're also helping investors to not overpay. Underwriters are ensuring that investors are able to save their money by paying a decent price, a worthy price, and invest their surpluses again back into the economy. So in this way, underwriters also contribute to the social welfare and economic well-being of an economy. Okay, so far we've gotten intimately familiar with the IPO process. But remember that this is not the only channel for issuing new shares. Companies with existing shares floating in the markets can choose to raise additional capital by selling more new shares or bonds to the public. This is called a seasoned offering. In the case of shares, it is called the seasoned equity offering, or an SEO. Other names are also available, such as repeat IPO, repeat offering, etc. Depends on the market. Now, on the surface, this seems like a perfectly fine and innocent way for a company to raise new capital. But in reality, an SEO is usually not a good sign. I repeat, not a good sign. Markets treat an SEO as a bad news, and the share prices usually fall. It is typically because the market believes that when an SEO is on the horizon, the firm must be running low on cash. Also, historically, we have learned that the founding members or the early investors of a company usually have in the IPO a specific amount of shares locked in for a specific period of time. So let's say they have a lock-in period of 5 years. That means after the company goes into an IPO, those elite investors cannot sell those shares for cash for the first 5 years. So an SEO can also be a sign that the lockup period is up and the early investors or the early owners or the co-founders or founders are now looking to get out of this company. So if the original people behind the company want to get out and are no longer bullish on the company, can you see why the markets treat SEOs as bad news? And that is usually, and I repeat, usually why the prices fall.